However, that is the complexion of the market today. But how are the long-term money? How is long-term money approaching the markets or observing things? Patient money, we're talking about insurance money. HDFC Life CEO Prasun Gajri is joining us now for a chat on that. Prasun, good afternoon. Thank you so much for your time. Yours is a differentiated view because you don't look at quarter to quarter, year by year kind of a lens. Surely you might be observing the quarterly numbers, but your perspective is much larger and longer than many in the market. How are you looking at the construct of the market, the resilience it showed despite in the face of second wave, and now we are also hearing conversations globally on Fed stop wanting to raise rates and all of that. At least conversations around that have started. What are your thoughts on the construct of the market?
So, well, the way we look at the market, I think the market is clearly did not react too badly to the second wave very clearly. We didn't see any massive fall, which was a bit of a surprise, but in hindsight, not so much. I think the recovery is clearly coming through as far as the pandemic is concerned. The case count is falling. So hopefully the worst of this second wave at least is going to be behind us. Maybe in a month and a half, and maybe slightly longer, but yeah, over the next couple of months, that should be behind us. So given that, I think the market is experiencing positive vibes in a sense that we are seeing some recovery over the last few days. But the way we look at the market, I think is trying to look a little bit beyond the current situation. I think market is already building in reasonable amount of earnings growth for the year and for FY23 as well. And on top of that, we are at slightly higher than long-term averages in terms of multiples. So it's not that it's very expensive, but on reasonably positive earnings growth, we are higher than long-term averages. So broadly, we remain a little bit cautious, not bearish on the market is the way I'd like to put it. I think why am I cautious? I think the impact of the second wave is yet to be fully understood. After the first wave, we had a strong recovery and a pretty much a V-shaped recovery as far as consumption was concerned and as far as the broader economy was concerned. This wave has been very sharp and has impacted the economy for a shorter period of time, but wherever the impact has been, it has been fairly intense. And also we are seeing some evidence that this has also spread to the interiors. So one would really wait and watch how this recovery pans out this time. Do we really see the kind of pent-up demand we saw last time? Is it weaker this time? That's a bit of a question mark. How is the banking situation going to look like? Virtually everyone, including us, have been building in a lower credit cost for the financial system this year. Now, does that change once this goes past? So I think those are some of the issues one has to really tackle from a market's perspective, which makes us a little bit cautious. On top of that, I do believe RBI has done a good job in keeping the rates contained, but can it really do so in face of inflationary pressures and the fact that the fiscal situation may not turn out to be very good, and we don't have any further fiscal room for any further stimulus which the government can provide. So this again makes us a little bit cautious. And you obviously mentioned about the global situation, global inflation, inflation in US rising, the interest rates in US coming up, some talk of taper again. Those obviously remain global risks, but I think they're very difficult to really pinpoint when that plays out. The momentum is strong in the market, as I said earlier, and the liquidity continues to remain good, which are the positive parts. So all in all, we believe that while there could be some earning pressure which could emerge this year, it may not be very significant, and therefore we are a little bit cautious without being bearish at this point of time. But obviously we are not very, very aggressive in terms of our positioning at this point of time. We are more balanced, balancing between the cyclical sectors, which we expect will do well, but at the same time, looking to add the more defensive sectors, the sectors which are more dependent on the global economy than the Indian economy, and balancing out the portfolio. So that is the way we are really approaching this market, given the situation.
Right. Just a follow-up question on the back of that, Prasun. If indeed, the corporate earnings on aggregate do grow 15 to 18% next 3 years, which appears to be the case the market is building in, Is that in the price yet? Can the market returns, or will it be justified to expect market returns also 15 to 18% CAGR next 3 to 5 years if earnings also grow in the same price? Or do you think returns could lack the earnings because some of it is already in the price?
If earnings actually grow in higher teens over the next 3 to 4 years, I think the market can definitely give good returns. I think the worry is only going to be if there is some sort of challenge to this earning growth phenomena, because how the economy really recovers, what are the long-term scars of the pandemic on the overall aggregate demand in the system, how the interest rate cycle really plays out as we go along. I think there are a lot of those issues which are not fully resolved as yet. And therefore, to take a call that earning can continue to grow in high teens for the next 3 to 4 years is, it may very well happen, but I think it's a little bit premature at this point of time. So we'll be a little bit guarded in terms of taking that approach. So I think that is where it is. But if earnings actually come out that strong, I don't believe there is any risk then in the markets, in a sense, then you can really make good long-term returns from the market.
Okay. So Prasun, let's break it up. Aggregate is always a median of a high, the ones which will definitely grow at a higher clip and the ones which may degrow. Areas where you think there is potential for high growth and perhaps the pricing is not fully factoring that very good healthy earnings growth going forward. Which are those areas to your mind?
So if we were to look at over the next 12, 18 months, I think in the cyclical sectors, the larger private sector banks, I think, will continue to do well. There could be some hiccups here and there in terms of some credit costs surprising on the downside, but broadly, these banks are well capitalized. They're capturing market share. And as and when the credit growth comes back, these banks are going to do fairly well. And the risk of any downturn is much lower when you're looking at the larger banks. So very clearly, we are very positive on the larger private sector banks as far as the cyclical sectors are concerned. On the defensive side, we are more bullish on the pharma space. I think that space is doing well and will continue to do well, both on the domestic side as well as on the export side. And we also remain reasonably positive on the IT space, though this quarter was a little bit of a disappointment. I think the longer-term growth story remains reasonably intact. The valuations are not significantly out of the long-term averages. So we remain positive on both IT and pharma as far as the defensive sectors are concerned. And apart from that, I think it's a little bit more stock specific, where we believe the earnings can be positive. But I think that is the way we are really positioning. So be positive on some of the cyclicals like larger financials, and also be positive on some of the global themes, global oriented sectors like Pharma and IT. I think that is the way we are looking at it.
I was reading your note, and it appeared to me that metals in an underweight area for you. Now, metals has been a big mover this year. Almost 60-70% is what the index is up by. It seemed to have become a market favorite, and the consensus on the street is that it is actually in a super cycle. Surely right now there's a correction going on in most metal counters. Where do you stand on metal, and what's the rationale of your cautious stance on metal, if I read it right?
Look, metals in the context of the market is a small sector as far as the index is concerned. So we are actually overweight on the ferrous space, and I think we continue to like that space at the margin. Having said that, after such a long rally, there is always some concerns which arise, and that is the reason we are taking a little bit more cautious stance on the metal space. Again, I believe metals has always been a trading sector, and to take a very long structural call on metals is a little bit difficult from a portfolio construct point of view. We will continue to dabble, we'll continue to book profits when we believe the rally has run through, and in case it corrects, we could look to add metals again. So it's not something which we are taking a long-term negative call on metals. It's just that given the rally, we have kind of come off, but we continue to remain positive as far as the ferrous space is concerned, and we are there pretty much invested in that space.
Perhaps that's a more practical approach to metals. When they appear expensive, sell them and get them lower. What are your thoughts on some of the reopening sectors which the market is favorably looking at? Travel and tourism, leisure, some of the travel related platforms, or even hotel companies. What are your thoughts there? Because retailers completely had a very bad patch there's a large part of the market is getting excited now, and perhaps on hopes that sequentially things will improve as stricter lockdowns go down, assuming that vaccinations pick up and the stricter guidelines actually are relieved. What are your thoughts there?
I think it's a fair assumption to make that some of these sectors will do well once the pandemic is behind us and things open up. And the evidence is pretty much available from some of the countries where economies have opened up and pretty much people are moving around. So I think why will it be different in India is very unlikely. So I think things will do very well once it opens up. I think the only concern is going to be that these stocks could run up very quickly based on the opening up, and then when the evidence kind of trickles in, it may not be as great as what market feels to be. So for currently, we remain positive on some of these names and we have some exposure, but we are definitely not going over significantly over it on this theme, purely because I think it will be more of a slow upward grind, and let's see how the evidence comes through when the things open up in terms of how people really react. So we will take it as it comes. But yes, this is one theme which could play out as and when things open.
Prasun, I'm deliberately coming down the market cap curve a bit because there are not many big stocks in the rural supply chain basket. Be it, agrochemicals, of course, there are some, but the big ones are often discussed, the UPL variety, the PI variety. But I'm talking about the mid-cap agrochemical space, fertilizer space, pump manufacturers, pipe companies, that entire value chain of the agri side. There's a lot of interest, commentary from them after the results seem to be suggesting buoyancy, but they have run up as well. Is there an area where you are also looking at some specific ideas or spaces, I would say? Because on the one hand, there is buoyancy on monsoon, etc. People are also saying the hinterlands have been badly hit by COVID, so things will not be very rosy there. What is your view on the agri supply chain space?
We are not really invested in some of the real small names given the size of the portfolio. That is a bit of a constraint. But on the agri side, we remain reasonably positive on the agrochemical space, and we have investments within that space. I think those companies are not that expensive, especially compared to some of the other chemical companies which seem to have run up much more. I think the demand situation will remain reasonably okay because I think while pandemic has spread to the rural areas, I think it is a little bit more anecdotal. And number two, it could be very geography specific. So let's wait it out how things really pan out. But for the time being, given the positive news on monsoon this year and the overall theme on the agri side, we remain positive on some of the larger agrochemical names. That's all I can really say because we are not really invested in the smaller caps in this space.
Right, sure, fair point. Let's shift focus and talk about the other area which was reasonably punished again. And each of these stocks, I'm talking about the auto space, are 30-40% lower compared to their previous highs. Because again, mobility got stalled, valuation had run up, and there is also supply issues of the a lot of parts, auto ancillary parts and other reasons. Automobile, what are your thoughts? Do you think it can come back to pink of its health 3-4 quarters far out and doesn't deserve this kind of a snub from the market and it's a good area?
Obviously, I think the stocks have corrected, but and for some right reasons as well. I think there are some longer term headwinds which are emerging, especially in the two-wheeler space. There is this chip shortage issue which has impacted production. There are the demand issues. But my sense is once things open up, you will again see some demand rebound, which could help the auto stocks do well. So one will be selective. I think we prefer the four-wheeler space compared to the two-wheeler space in this area. We also like tractors, but one has to really wait and see how the demand on the tractor side really pans out given the current phase of the pandemic, what kind of impact it has in the first quarter, and then we'll really take a more longer term call on that. But that has been one area where we have been positive in the past. So overall, more four-wheelers and tractors compared to two-wheelers is the broad call we have on the auto space.
Right. In fact, talking of tractors, Mahindra did come out and run down their guidance on tractors just recently. Great chatting, Prasun, always with you. Thank you very much for your time and look forward to having more conversations going forward. Let's take a short break on that note. More news and analysis on the other side. Don't go anywhere.